What are options? By a Pajama Trader, Part 3. A recap on stocks. Active stocks are heavily traded stocks on an exchange, or stocks that display a sizable price movement within a single day. These stocks give investors insight into liquidity of these securities, how the market feels about these companies, and their price movement. There is no specific volume benchmark to define an active stock. News developments such as tender offers for the company or positive earnings or large number of shares outstanding drive a high volume of trading for stocks. Active stocks list show investor stocks with the highest trade volume, the biggest gainers and losers, the stocks with the highest daily volume, the most active stocks by index. The breakdown on options. Options are financial derivatives. They give the holder the right but not the obligation to buy or sell an asset like stocks at a specific price. The specific price is known as the strike price or exercise price. Options have a predetermined time frame known as the expiration date during which the holder can exercise the option. There are two types of options: call options, which give the right to buy the asset, and put options, which gives the right to sell the asset. Call options are typically used when the holder expects the price of the underlying asset to rise. Put options are used when the holder anticipates the price of the underlying asset to fall. Option holders pay a premium to acquire the option contract, which is the price of the option. Option trading can be used for speculation, hedging against market movements, or generating income through covered call strategies. If the option is not exercised before the expiration date, it becomes worthless, and the option holder loses the premium paid. Option involves risk and includes potential loss of the entire premium paid depending on the movement of the underlying asset. What are the difference in calls and puts? Call options. The purpose for the call option gives the holder the right but not the obligation to buy a specific quantity of an underlying asset at a determined price, strike price, before the expiration date. The function. Buyers of a call option speculate that the price of the underlying asset will rise, allowing them to potentially buy at a lower strike price and profit from the price difference. Sellers of call options, writers, receive premiums from buyers and are obligated to sell the underlying asset if the option is exercised by the buyer. Call options can be used for bullish strategies, speculation, income generation, and hedging against short-term price increases. Put options. The purpose: put options gives the holder the right, but not the obligation, to sell a specified quantity of an underlying asset at a predetermined price, strike price, before or on the expiration date. The function. Buyers of put options speculate that the price of the underlying asset will decline, allowing them to potentially sell at a higher price or strike price and profit from the price difference. Sellers of put options, writers, receives premiums from buyers and are obligated to buy the underlying asset if the option is exercised by the buyer. Put options can be used for bear strategies, speculation, income generation, and hedging against short-term price decreases. The key differences. Directional bias. Call options are used when anticipating the price increase in the underlying asset, bullish. Put options are used when anticipating the price decrease of an underlying asset, bullish or bearish. 2. Rights and obligations. Call option holders have the right to buy the underlying asset but are not obligated to do so. Put option holders have the right to sell an underlying asset but are not obligated to do so. Profit potential. Call option buyers can potentially profit from an increase in the underlying asset's price. Put option buyers can potentially profit from the decrease in the underlying asset's price. Seller's perspective. Call option sellers may need to sell the underlying asset if the option is exercised. Put option sellers may need to buy the underlying asset if the option is exercised. Premiums. Both call and put options involve payment of premium by buyer to the seller. Now we're going to go over some option terminology. Strike price, also known as exercise price or target price. The predetermined price at which the underlying asset can be bought or sold upon exercise. Relevant for both call and put options. Influences the option's profitability and whether it's in the money, at the money, or out of the money. Expiration date. The date which the option contract must be exercised or it becomes invalid. Options have a finite lifespan, with expiration typically occurring on the third Friday of the month for standard options. After expiration, the option becomes worthless and no longer holds any value. Premium. The price the buyer pays to acquire an option contract, determined by various factors including the underlying asset's price, time remaining until the expiration, implied volatility, and prevailing market conditions. Representations of the maximum potential loss for the option buyer and maximum potential gain for the option seller. Intrinsic value. The inherent or real value of an option derived from the difference between the current price of the underlying asset and the option strike price. For call options, intrinsic value is greater of zero or underlying asset strike price minus the strike price. For put options, intrinsic value is greater of zero or strike price minus the underlying asset price. In the money options have a positive intrinsic value. At the money and out of the money options have intrinsic value of zero. Option buyers, option sellers. Option buyers, holders, the role. Option buyers are individuals or entities who purchase options contracts from option markets, from the options market. The motivations: speculation, hedging, leveraging, income generation, portfolio diversification. On speculation, buyers can anticipate future price movements of the underlying asset and seek to profit from those movements. They may buy call options if they expect the asset's price to rise, or put options if they anticipate the price to decline. In hedging, investors use options to manage the risk of their portfolios. For example, a stockholder concerned about potential price drops might buy put options to offset the potential losses. Leverage. Options allow investors to control a larger amount of an underlying asset with relatively small upfront costs, the premium. If the price moves favorably, the potential percentage gains can be substantial compared to the initial investment. Income generation. Covered call strategies involve buying the underlying asset and selling call options against it. This generates income from the option premiums and can provide a downside protection. Portfolio diversification. Options offer an additional layer of diversification, allowing investors to gain exposure to different assets and markets without directly owning them. Option sellers, writers. Role. Option sellers are individuals or entities who create and sell options contracts to the market. Motivations: income generation, speculation on stagnant markets, risk management, acquiring assets at preferred prices, neutral outlook. For income generation, option writers receive premiums from buyers, which can serve as a consistent source of income. This is particularly true for individuals who engage in strategies like covered calls or cash-secured puts. Speculation on stagnant markets. Sellers may expect the price of an underlying asset to remain relatively stable. In such cases, they can benefit from the erosion of the option's time value, beta, over time, allowing them to keep the premium. Risk management. Institutional investors and market makers often engage in option writing to manage risk. For instance, market makers provide liquidity by constantly quoting bid and ask prices, facilitating smooth trading for options buyers and sellers. Acquiring assets at preferred prices. Put options writers may be willing to buy the underlying asset at a lower price if the option is exercised. This can be beneficial for investors in seeking to accumulate assets at discounted prices. Neutral outlook. Options writers might sell options to take advantage of situations where they don't foresee a significant price movements in the underlying asset. They can profit from the time decay and minor price fluctuations. Now we're going to go over the benefits and risks. Advantages of trading options. 1. Leverage. Options provide the opportunity to control a larger position of an underlying asset with a relatively small investment, the premium. This magnification of potential gains can lead to higher returns compared to investing directly in an underlying asset. 2. Risk management. Options can be used to hedge against potential losses in the portfolio due to an adverse price movements in the underlying asset. Hedging strategies such as buying protective puts help mitigate downside risk and provide a level of security during market downturns. Options allow investors to tailor risk exposure according to their risk tolerance and the market outlook. 3. Income generation. Writing options such as covered calls or cash secured puts can generate consistent income through premium collection. This income can serve as a cushion against potential losses or supplement overall portfolio returns. Diversification. Options enable investors to gain exposure to various assets in the markets without directly owning the underlying securities. This diversification can help spread risk and reduce dependency on a single asset's performance. Risk of trading options. Potential loss of premium. Buyers of options risk losing the entire premium paid if the option expires out of the money and is not exercised. Sellers of options face potential unlimited losses, especially when writing naked uncovered options, where they may need to deliver the underlying asset in an unfavorable price. Limited lifespan. Options have expiration dates, leading to a limited time frame for the trade to play out. The anticipation price movement doesn't occur within the specific time frame. The option can expire worthless. The complexity and trade risk. Trading option involves various strategies that can be complex and require deep understanding of the market dynamics. Incorrectly executed strategies can lead to unexpected losses and missed opportunities. Market volatility. High levels of market volatility can impact option prices and increase the risk of unexpected price movements, potentially leading to losses. Liquidity and bid-ask spread. Some options may have low trading volumes and wide bid-ask spreads, making it challenging to execute trades at favorable prices. Assignment risk. Sellers of options may be obligated to fulfill their contract obligations if the option is exercised by the borrower. This can lead to unexpected transactions, especially for naked option writers. It is crucial for investors to thoroughly educate themselves about options, understanding their risk tolerance, and consider seeking advice from financial professionals before engaging in options trading. Options can offer powerful tools for achieving financial goals, but the complexities require careful consideration and risk management. Thank you for watching. If you find value in these videos, please like, share, and subscribe. And there'll be many of these videos to come.